Hey, it's Lon Welsh, and I'm going through a number of frequently asked questions that I get from our investors all the time, and I want to share them with you on this video. So one of them is, should I sell my rental property? And if I did, how would the wealth improvement I get with Ironton Capital be different from the stock market or just doing nothing at all? So I'm going to show you a real life example I did for one of our investors really recently. She bought a house about 10 years ago for, I think it was $200,000. It's worth 675 now, and she's got about 100,000 bucks worth of debt. So her equity is 577. A lot of you who bought 10 years ago are in that situation, and you're probably sitting on a sweetheart mortgage at a low interest rate on top of it. The cash flow each year looks like this. There's about 40,000 of rent. Her direct expenses like tax and insurance and the water bill are 5,600. She's got maintenance reserves of 2,300 and a vacancy loss reserve of 1,200. So her net operating income, NOI, is $30,000 a year. She does have a mortgage. It's like very small. So if you have a mortgage payment, you would take that out of this as well. Since hers was so small and it's just about paid off, she's making extra payments on it. We just disregarded it for this analysis. So what kind of wealth generation is she getting on this? So she's got 675 of value. We think the property is going to go up 4% a year in value. Over the last 50 years in Denver and most of the Front Range, the appreciation has been close to 6% a year. We think it's going to be a little less on average over the next 5, so we picked 4. So with the value of 675 today, 4% appreciation is 27,000 bucks worth of appreciation every year. Her cash flow is the $30,000 that we talked about. So her total return is $57,000 a year. So if you recall, her equity after the debt is 577. So if you make $57,000 on an investment of 577, your return is just about 10% per year, which is not too bad. So what would happen if she did nothing? So if she does nothing, she has no transaction costs, no capital gains. So the amount that she can invest is 577, just no change at all. And her property equity is going to grow in total by just under 10% per year. That's this total return we talked about just a second ago. So after the first year of investment, her value will be 634. It's the 577 she started with, adding 57,000 is 634. Then next year, we're going to add on another 9.9%, and that's going to get us up to 700,000. And you can see that the second year gain of 63 grand is bigger than the first year gain of 57,000. So that's called compounding interest. You may remember my favorite Einstein quote is, compounding interest is the eighth wonder of the world. The man who understands it collects it, and the man who doesn't understand it pays it. And you can see that due to compounding interest, our gains 63,000, 69,000, 75,000, 83,000. She's going to see her equity grow from 577 to 924 just in 5 years. And then if we go for another 5 years after that, you see that her equity will grow to $1.5 million. This is why I love real estate. It's just fantastic. So she's a little bit tired of being a landlord, though. She'd like to move on and be passive. So what would that look like? Well, if she took this property and sold it, she'd have some sales costs and some capital gains that I estimated. And of course, you'll want to work with your CPA to estimate those. So let's pretend we're going to sell the property and put it in the stock market. So I've got 577 of equity today, but I'm going to have transaction costs of 37 grand and capital gains of 49 grand. So what I'm left with that I can actually invest is 490. And the stock and bond market, if you take a look over the last 70 years or so, I put this in option 1 in the footnotes, and you can get this Excel sheet from us. I'm happy to share it with you. The average stock market gain since 1970 is 10% per year. The bond market on average is 5.3. If you did a traditional portfolio, 60% stock, 40% bond, which is a very common mix that a stockbroker would recommend, your return would be 8.1. You can change this spreadsheet to whatever you want it to be, but that's what I most commonly hear of our investors who are trying to decide between their options. That's usually what they're at. So if I've got 577 and I've got to pay the transaction costs and the capital gains, And if I can invest it at 8.1%, what will I have in 10 years? And the answer is, with my stock and bond portfolio, it's going to grow to be $1,070,000. So this $1,070,000 is not as good as the $1,005,000 I have just by doing nothing. But here, by doing nothing, I've got to continue to be the landlord and manage the property and not have a passive lifestyle, as opposed to with the stock market. I sell it, I pay my taxes one time, stick it all in Vanguard and forget about it, and I'm just off to the beach. So for some of our investors, that's a great option. What else could we do? Well, another good option is we've got something called the Medium Term Income Fund here, and we did a raise for Medium Term Income Fund 1 in late 23, and we're going to have MTI 2 probably in late spring of 24. And our goal for that fund is to pay between 11 and 13% annual interest, and that comes out every quarter. So the amount that you get depends on how much you have invested. The more you invest with us, the higher the interest rate. No surprise there. Let's pretend that you're going to get in the 12% bracket. We would be sending you 3% every quarter. So for our older investors that need this income to fund their lifestyle and retirement, this is really great. You could sell the income property you have today. So let's pretend you paid it off. You had $30,000 worth of income that you could live off of. With us, you'd be getting something on the order of $60,000 of income. So you would basically double your income from $30,000 to $60,000 by making this change. Let's take a look at how it all works out. So we would have to pay the transaction cost to sell the property. We would have to pay the capital gains tax. We'd have $490,000 to invest. And with the old property, you remember we were making just under 10% per year. We're going to make a little bit more with the medium term income fund. We're going to make 12% a year. And over a decade, you can see this grows to where it's almost the same amount of wealth appreciation. Investing with us in MTI gets you to $1.5 million. Sticking with what you've got right now, also $1.5 million. So this is just sort of stylistic between the two. What do you more prefer? So if you still enjoy being a landlord, sticking and doing nothing is probably the correct answer. If on the other hand, you're sick of being a landlord, you could sell it, pay the capital gains tax, invest with us, end up in the exact same space wealth generation wise, but not have the headaches of dealing with the tenants anymore. So a lot of people are finding that to be very attractive. This is why we raised almost $9 million in 6 weeks for MTI. When I explained this to investors, it was like very easy for them to connect the dots. Note that this is quite a bit better than the stock market option. It's a very, very attractive opportunity. So one other option is you might take a look at our National Diversified Fund. So when I put this spreadsheet together, we were raising for NDF 7, but all of our National Diversified Funds work the same way. So when you're watching this, we might be raising for NDF 10. It'll be the same strategy. So something important about NDF is we have two share classes. One, if you don't need depreciation write-offs, and your CPA could help you figure out if you do or you don't, we could put you in a share class that you get a higher preferred return, but you get no depreciation. So if you're investing in an IRA, for example, that might be really good for you. If on the other hand, you're selling your rental house, you're going to incur this capital gain, it would be really nice to have a bunch of depreciation from a write-off in your investment with us, and you could use the depreciation write-off to offset some or maybe even all of the capital gain and wipe the capital gain out. So I can give you the broad strokes of this, but of course you'll want to collaborate with your financial advisor and your CPA for your unique situation. Usually what we can find is that for the investors that want a depreciation, if you invest, say, $100,000 in NDF, we'll be able to give you $40,000 to $60,000 of write-off in the first year. In this particular case, if you did the math and we talked to our CPA, we were able to offset all of our gain and defer the taxes until later, which was great. So what you have here is $577 of equity, and you've got to pay the same transaction costs as stock market or medium-term income. But what's great is you don't have this capital gains liability because she decided she would get the depreciation shares and offset her capital gains until later. So she has more to invest, $540,000, than the stock market or the medium-term income. That really, really helps a lot. For all of our national diversified funds, historically, we've been on track to return between 15 and 20% a year. Around 17% is our target. So how does NDF stack up to the other options? Well, over a 10-year period, you can see that you wind up with $2.6 million after the end of 10 years, as opposed to do nothing is 1.5. So you can actually sell the rental property, offset some or most of your gain, be completely passive and go and sit on the beach, and in 10 years you're going to have over $1 million more than you would have had if you would have continued being a landlord fighting with the tenants. So I think you'll want to take a look at this option and to see if it's a good match for your family. Maybe you are like Jay, who shared, Ironton Capital helped me reduce the time and headaches I had when I managed my rental. Jay actually sold his rentals, and not only has it made his life a lot easier, we're on track to beat his returns now too. Like Jared, who after 15 months struggling with nonstop with his rentals, he sold many of them to invest passively with Ironton Capital. He says it feels good to have the time back now with passive investments. Ironton made it really easy. As John points out, I believe I have moved my money from an unpredictable market subject to many economic factors and significant risks to a fundamentally sound business model that's a hedge against inflation. I recommend them to my friends and family with confidence. Would you like for us to do an investment review for free? Go to irontoncapital.com/review and choose your time, and we'll be able to deep dive with you on your personal view and goals and answer any of your individual questions. Sound good? We have a lot of projects in the works, so our time is limited, so please go ahead and secure your spot now. We can't wait to see how we can help you with your investment goals as our gift to you.